Good evening, members. Welcome to the topic of issue of shares in a private limited companies. Today we have a very eminent speaker, JK Sharath. I request him to come on to the dais. And we have a senior member, CA JK. I request him to hand him over a floral bouquet and a memento to welcome him. I take a privilege in introducing the speaker of the day. Of course, not only just as speaker, of course, we've been working together for quite a long time, even in my previous company. We have JK Sharath, who is a partner at BDO, MSKA and Associates. He has more than 2 decades of professional experience in audits, reviews, internal control, reporting under IFRS, US GAAP and capital markets. He has experience of working with domestic and multinational companies in various sectors and with the companies having operation in multiple jurisdictions. His experience spans across industries including manufacturing, technology, consumer goods, life sciences, etc. He specializes in multiple GAAP reporting like Indian GAAP, Ind AS, IFRS, US GAAP, and has an experience in GAAP conversion. He has extensive experience in capital market transactions like IPO, QIP. He has led the implementation and monitoring of internal financial controls as well as SOX in various companies. Sharath is a regular speaker on technical topics at various forums. He has conducted moderation sessions with various eminent panelists as well. He is a fitness enthusiast and likes running and trekking, and I can see his transformation. With this brief introduction, I would like to hand over, and also the relevance of the subject when I was speaking to him today. What he was mentioning me was the share capital issuance and their maintenance and their monitoring has become a very critical essence considering the Companies Act provision. So he's been telling me that he's qualified a couple of accounts and the implications thereon. So it becomes very critical for us to examine the implications both in auditing angle and the compliance angle as well. So with this brief introduction, I would like to hand over the stage to you. Over to you, Shiv.
Always be back to the institute from where our root comes and share the knowledge and the experience which we over a period of time gain by keeping the pace as what institute gives us. Really happy and excited. And like Pramod said, this is a very unique topic for me. I come with a lot of audit background, but like he said, compliance with Companies Act, issue of shares have today become very critical, and especially in Bangalore market, right, where we are. What really happens, we come across a lot of startups, a lot of private companies which are there, which sort of go through this whole process of capital raise, fund raise, various rounds of funding, and issue of capital, because capital is one of the key source for you to sort of run your operation, right? You also have borrowings and working capital, etc. But the primary source would always be, the start would be your capital, how you invest and how you start off deploying them in whatever objectives you have in your businesses. Somewhere down the line, in the euphoria of raising the funds or in doing all that, what I have noticed is I've seen there's a lot of sort of gaps which come up in looking at what are the real compliances, and like Pramod mentioned, I was discussing with him these sort of non-compliance which may sound very small or minuscule, but if you see some of the recent MCA orders or some of the compounding applications which have gone, they have been treated very seriously. In fact, I'll take you through the provisions, the amount of qualification or the penalties, right? And the implications are very huge. In some cases, it says few crores you will have to pay, right, if you default in any of these provisions. So it's not as something very small which can be ignored. So it's very critical and very important aspect of any life cycle of any company. So this is a broad content of the whole presentation which I am going to do. Primarily, I will take you through the various options in which a private company will be able to sort of raise their capital, what are the means, how it works, and what are the various Companies Act requirements. While you would see private placement rights issues are an option through which you would actually get additional money through the company, whereas in ESOP and bonus shares you may not get the money, but it's still sort of increasing or decreasing your share capital as such in your this one, and there are a lot of guidelines, and the section clearly mentions what you have to do, and I have also noted certain non-compliances or certain challenges in these which I will sort of highlight them when I come to some 10 case studies I have with possible solutions. So let's go ahead deep dive. So if you go to the provisions of Companies Act, Chapter 3 of the Companies Act sort of deals with the share issue by any company. So if you see, Chapter 3 has a very small mention for a private company. Mostly the Chapter 3 deals with prospectus and allotment of securities, and mostly you would always correlate a prospectus and allotment to a large public company or listed entity which would call for a prospectus, go for a public fund raise. But still, if you see 23 paragraph 2, it says that a private company may issue securities by either a rights issue or a bonus issue, right? Following the provisions of this Companies Act. And then it also goes to say that you can also raise a capital by doing a private placement, and of course complying with the provisions which come in the next part of this chapter. So primarily, if you see what are the options you have a bonus shares, you have a rights issue, and then you have a private placement. These are the primary very high level means through which additional capital can be sort of bought in by a private limited company. Now I'll take you through each of this in detail, saying what the provision says and where are the challenges and what are the key elements, the fine prints, etc. and all that. So the first one being private placements. So like the name says, private placements, while you would go to a group of investors and try to raise the money, since it is a private placement, there are certain restrictions on how many number of people you can go through and what you can do, what you cannot do, unlike a placement by a public company, right, where they would go in and file a public announcement, make a press release, or give this one in the newspaper. All those are sort of prohibited to be done by a private company. So the private placement is really a private affair, where you will find a private set of people who are interested to invest, and then you would call for them to sort of come and invest and do a private placement in the company. So section 42 of the Companies Act sort of covers the whole provisions of how a private placement has to be done, and what are the guidelines, what has to be followed, and what cannot be done, etc. etc. Then we have the rights issue. So the difference between a private placement and a rights issue is, private placement can be done to anybody, right? He need not be my shareholder or anything like that. But a rights issue is an incremental right you give to an existing shareholder. So an existing investor or a shareholder will get a right to sort of subscribe to an incremental shareholding, which share rise which you are trying to do. And of course there are a lot of requirements specified under section 62 for the rights issue. I will take you through in detail the rights issue provision. It can be to a specific people or to all the shareholders, but you start with all of them, and then somebody can renounce their right and then it can then be given to somebody else so that the company's interest and the organization interest is taken care. Then of course you have preferential allotment. So in a preferential allotment, you would give preference to some individuals to give the allotment and not give it to everyone equally. So there are certain guidelines again covered under section 62, which would say how you would go about doing a preferential allotment. Then the other two, which I would say are kind of a cash benefit, while I can't undermine, because if you really see, ESOP is something which is very incentivizing a lot of employees and helps a lot of companies in the early stages to sort of make sure they engage and retain the talent by giving ESOP. That's also a very, very important manner through which incremental shares can be issued. While there may not be real value coming out of it, money coming out of it, but really there is a huge value to it which people would see, and we have obviously seen many of them carrying a lot of ESOP values. Then of course is the bonus issue. Bonus issue, I think recently has been very, very not so common in private company, primarily because of the tax issues which was plugged in few years back. So I see very few bonus issues happening, while this option is still there. It's more a non-cash kind of a capital change, where you will give capitalize your reserves or whatever profits you already have, and you give incremental shares, additional shares to the existing shareholders. So primarily there is no consideration or no incremental cash which comes in, but you have the shares which goes up, and your shareholding and number of shares increase, and again it is covered by section 63 of the Companies Act. You have the guidelines which are there.
What is the difference between preferential allotment and private placement?
So private placement is primarily more a guideline which is there, which says that you do a placement to a private set of investors. It can also be a rights issue if you are doing private placement, right? I have 10 shareholders, so privately I will call them and say, okay, I will do a rights issue. Okay, so the rights issue and preferential allotment are the manner in which you will issue the shares. Private placement is where you will call for a private kind of a people. In a private company, you cannot call more than 50 people. That's a restriction you have, and you can get. Preferential allotment, one key thing between preferential and private is preferential goes to existing shareholder also. Like you already have existing shareholder, let us say you have 10 shareholders. You determine you will give a preferential allotment to only 3 of them.
So let's say there are existing just 2 shareholders, and I want to give some shares to a third party, just one other third party. I can do a preferential allotment.
Yeah, you can do.
And if I am giving shares to both existing shareholders plus a new guy, I can still do preferential allotment.
You can do anything anywhere except rights issue, right? Rights issue cannot be given to a new shareholder, but private placement preferential allotment can be done to anyone. But the procedures are different. It's like if you see in a private placement, you will have to mandatorily follow those guidelines of opening, prospectus, right? And getting a special resolution, and having those explanatory statements for those special resolution, including valuation, etc. Preferential allotment, you don't need all those. Yeah.
Okay.
It's little more simpler.
So it's easier to do a preferential allotment.
Yeah. But when you are doing little at a larger scale, right? Let us say you want to go to 30, 40 investor and kind of give the same option to all of them.
Okay.
Then they may say, I want a preferential allotment.
So why would people go to private placement if preferential allotment is easier?
No, so in a private placement, there is no guarantee that all of them will come, but you will have a document which will be made, which will give the benefit of why they can invest, how they can invest, or what is the value in it. Right? Preferential allotment, you already have identified an investor. So here you will have a prospectus, so you can do those sort of shows privately, right? And say, yes, I have all these, I want to do this private placement. Whereas preferential allotment, I already know these are the 2 guys, I will give them. So that runaway to that can be achieved in private placement.
Preference share allotment is the same at par with the preference share.
So the kind of shares you can issue here, there is no restriction, right? You can either give a preference shares or you can give a equity shares or even shares a differential, right? There is no such.
Yeah. For preference share allotment, there is no restrictions. You can issue the equity and preference both.
Yeah. Any kind of shares can be issued in any of these. Okay, now we'll go to each one of them. The first one is the private placement. So, Section 42 of the Companies Act deals with the subscription of securities on a private placement basis. Like I said earlier, the number through which the board can go and give this offer cannot exceed 50 in case of a private company, while we don't have that restriction for a public company. But what happens moment you go for a public at a large, you have broader rules and sections which are applicable, including SEBI guidelines, etc., which are much more stringent and rigorous, whereas here you see it is, compared to that, it is a lot more simpler and easier. And this 50 number excludes some qualified institution buyers and ESOP, of course, which you are giving to any of their employees. If you are giving it as an employee, you can have more than 50 employees whom you can give ESOP, so that exemption is given.
Even after if this ESOP is converted into the equity shares, there can be number of employees.
Yeah, that is the exemption they have given, yes. So there is no, so I will come to that part also where I will take you through the ESOP
Any
provision.
rights will be different in ESOP?
It depends on how you are giving, what kind of shares you are giving. So what really happens is ESOP, initially you will give them an option which will over a period of time get vested and become shares, right? So you will decide what kind of shares that will be, what class of shares. So if you have different class of shares, you would say this class of shares are the
And
ones.
if shares are issued with the same class of the shares with the companies having the existing shareholder, will it make any difference to the companies and a total number of the shareholder, this limit which is 50?
No, it won't. So when you are, let us say, doing a private placement and you also have some employees to whom you are giving a private placement. So if you are giving to employees as an ESOP option, so that numbers won't be added to arrive at the 50 number.
Even if the employee left the company?
No, if the employee leaves, you would not give him a private placement, right?
No, means once he has been given the private placement or ESOP, he has exercised the rights of converting it into the shares after certain times, and he left the companies.
Yeah.
So what will be the status?
Yeah, it will be, because he is exercising his ESOP, right, which is given to him.
So, but the limit will not be applied to him for 50 numbers.
Yes, the numbers, if you are doing a private placement and an employee is exercising his ESOPs, then it won't come. It has to be, right? Practically, if you see, if I have, let us say, 500 employees, if I restrict it,
so the people can do the things if they want to increase the number of the, they can show as an employee and then they will issue the shares and then the people can get out of the...
No, only ESOP, only ESOP. If you are issuing through an ESOP, only it falls under this criteria. So it can't be like he is an employee and also he is getting ESOP and he is also a other shareholder, right? Like he can also subscribe. No, in that case he will come.
No, what I am saying, suppose a company want to make the list of the member as 100. They know the statutory limit is of 50.
Yeah.
So the 50 number they will make them their employees, and then they can make a private placement or the preferential allotment or they can issue the ESOP.
Yeah.
And then the employee can left after 2-3 years.
Yeah.
The limit will remain the 100 members.
Correct. It will be because once you give him an ESOP, he'll become a shareholder, right? So your number of members will be more. So because generally the number headcount will be higher, right, for you to give, that is why they have not tried to include that and restrict
Any
here.
restrictions on the limit of the amount is there in ESOP or preferential allotment and the private placement?
No,
On
so
the capital.
yeah, what overall ESOP you can give, there is a limit. Your total share capital, there is a cap, and which kind of employees you can give, whom you cannot give, is all capped there. It is not that anyone, everyone can just like they get it, and there are proper rules which are made. It says how an ESOP can be granted. I will take you through. I think subsequently when I come after this one, ESOP I have.
And private placement also the same rules are there.
Yeah.
Limits.
Private placement only the limit is for 50. You cannot go with a private placement for more than 50 if you are a private company.
And then these are counted in the 50 numbers. No.
Employees are not counted in the 50. Employees and the qualified institution bias. So there are some people who fall under QIBs. So those don't get counted under this 50 limit.
Number is 50. Maximum.
Yes, maximum you can go to 50 people
In one
at a time.
Achha, in one go.
Yeah.
If
So this, the way the private placement will happen is you will open a prospectus and an offer document. So that can be subscribed maximum by these 50 people.
And secondly, after 2 years, then also they can meet.
Yeah. So immediately there is no time limit for you to do a next fundraise, right? You can anytime do any
Then also
fundraise.
second time they can be 50.
Any fund, yes, correct. Each and every private placement maximum is so much. So it's not that every time I have to go to the same 50. No, next time I can go to different.
But in a financial year.
Yeah.
In the financial year.
Yes. So here again, yeah. So here if you see private placement means any offer or invitation to subscribe or offer to security. So I will sort of make an invitation, send this prospectus which is privately made, which contains all the details, right, of the explanatory statement to the special resolution. It will have a lot of things which you have to make. You will document like a prospectus, and that you will sort of give to all of them who will do the private placement, and then give them an offer for applying, and once they satisfy all the conditions, then you can sort of get the issue done to them.
So it's still a specific group of people which are already identified by the company.
Most of the cases, see, it will be identified because see, since it is a private placement, right, you need to know whom you are going to. Unlike a public, that is a difference. In a public, what happens? It is public at large for a listed company or a public company. So they make a newspaper announcement. So anybody can go to apply all that. That is not going to happen here because it is limited and fixed one. Generally, the way practically how it works is you already do all your homework, right? You already do the presentations to the investors, and then you identify the set of investors who are sort of okay to prima facie okay to invest within these limits, right? 50 is actually a very large number. Generally, it is not. It's not that you always tend to come near the 50 saying, I want more people. No, it's not, because you also don't want maximum. You also don't want a lot of members, right? And most of the, especially any fund or anybody who wants to invest, right? They already have accumulated people who are there, and they make a fund, and the fund will invest. So that fund will still be one investor, not all of them. So that way, it's already identified, but you may give to 20, 30, right? And in the end, 15 or whatever, right? I'm just giving you some numbers. Somebody may finalize and come by that time and approve and go ahead.
Not everyone might subscribe.
It depends, right? How you have negotiated, how it has done.
But discretion is with the company only to whom they are
Identify, yes.
No, identification is different. You are inviting the 10 shareholders.
Yeah.
And 10 they have applied for the private placement. Now, how will you decide to whom it is to be given?
So there is no kind of a subscription or under subscription that won't generally apply, right? So you already know how much. Let us say you want to raise 100 crores, just an example, right? So when you go and meet each of them with this prospectus, they will sort of show an intent of how much they want to invest or how much they don't want to invest. So based on that, you start digging, and then you try to see how you will come up to your 100 crore limit, and then do it. And then you say, okay, I only want to do a 100 crore raise. If somebody like you already come to 90 crores with confirm, right, informally confirm, and you have 10 crore only which you want to raise for that, and somebody says, no, I want to invest 20. So you can then decide, right, whether you want to limit it to 10 crore or you increase and go ahead, what do you want? So you have an option, you can always discuss and decide. As long as you are complying with whatever formalities they are given in this section, it's fine. Yeah, so the subsection 4, if you see, it says once every person is willing to subscribe to this issue, so he shall do a private placement by subscribing through a banking channel, right, and through a check or a bank draft or other banking channel, and no cash will be involved in doing this private placement. So it has to be through a banking channel only. This proviso is very, very important. Here you will see that provided that a company shall not utilize monies raised through private placement unless allotment is made and the return on allotment is filed as required by subsection 8. So now what happens? You may collect the money, right? And you have some time to allot it. There is some time limit which is given within which you can allot. You will have some time. So what you do with the funds within that time? So the section is very clear. It says you will not utilize that money for any other purpose unless that form after the allotment you need to file a form with the ROC, pass form. Unless that form is filed, this money cannot be returned. This is very, very critical and important. Various situations we have seen that a lot of companies are in very urgent need of money, right? And they need to sort of meet all their obligations and liabilities. So it's like you have a money but you still can't use it. And if you use it, then you are not complying with this provision. And I will come in the next slide. What are the consequences of non-complying with this? You will see those are not very simple, right? So that way, it is very, very important that if you are in an urgent need of money, do the collection allotment very quickly and file the pass very fast.
So that happen in the one day also.
Absolutely, yeah. I mean, you got it bang on the nail, right? If you want it urgently, do everything on the one day and close it, rather than doing the non-compliance, right? But it's very, very critical that money is not utilized. In fact, I also had various queries where they say, okay, I don't utilize it, I will keep it in an FD and earn interest. Why should it be idle for 15 days? Because sometimes the amount is significant and large, right? So there are various perspectives and view which says that allocating the money to a separate fixed deposit of the company also sort of tantamounts to utilization of the money. So here the wordings which they use are not utilized monies. So you putting in FD also in the manner indicates you have utilized. So there are cases where there is issue if you say you have separately diverted it to a fixed deposit. Well, you may not have actually used it for whatever purpose, but still even putting in a fixed deposit is sort of not acceptable.
Sir, what if ROC portal is not working? Let's say we were raised fund recently and ROC portal was not working.
Yeah,
so we have to wait for 2-3 days.
Correct, yeah. That is there actually. Recently I have also come across a couple of my clients where they had this issue. I think you have to factor it. This is a more practical kind of issue, right? Where you have find alternate means, right? I had known one of my known person who went personally to the ROC and gave this. And they got an acknowledgement because said your portal is not working and I need this right to be done. I have to make sure this compliance happens. So you have to find alternate means to see that you are complying with those requirements. But generally, past the we don't have much issue. I have not seen for a larger issue. I know it is there for a couple of days, and sometimes when there is some changes happening, it is there. There is a challenge. But yes, it's a very, very good point. You have to factor all this. If you think yes, one day I will come, everything will happen. Not everything is under our control. You know, you are dependent on others. Yeah.
Now, what is the relevance of this form? Why is it so important? Is there any background to it?
So primarily here, what you see is the person who is giving the money, right? He's not got any shares. He's giving it under a trust to you, and legally the allotment is fine only when this form gets filed with the ROC and it gets registered there, right? You say yes, as per my legal records, this is done. There are again very I think 15 days you have to file a pass once you have done the allotment. So they don't give you actually very large time also. It's not like okay you have 6 months to do it or anything. So primarily it is for the person to get a comfort, right? Because your share certificate or whatever will come after some time. It's not that the day they are allotted you get it in a demat form. No, private companies it does not happen. Even public company to get in your demat account it takes 2-3 working days, right? Or even more, depends on situation. So just for making sure that your money is secure as an investor when you are putting the money, your money is safe, secure and not diverted. So let us say if the money was used somewhere and they decided they have to refund it back. Where will you get the money? So you are basically putting the interest of the investor in a detrimental position. Just to avoid all that, yeah. Okay, and no fresh invitation can be made if one allotment is still pending, right? If you have already made one allotment and it is still not closed, you cannot call for a new private placement to be done. So one private placement has to be completed fully by filing whatever required, and then you can start with a new private placement. There is no restriction of number of private placements which can be done. Yeah, so this is the provision, right? If you see, if you look at the subsection 6, right? It says a company making an offer of invitation shall allot within 60 days of the date of application. So once the money has come, you called for application, you got the money, within 60 days you have to allot whatever securities you have called for, whether preference shares or equity shares or whatever shares. And in case you are not able to do that, it says within 15 days from the expiry of the 60 days, if the company fails to repay the application money, then you will be liable to pay interest or whatever. So first, within 15 days, you will have to repay that money. So if you have got 100 crores, you didn't allot, the losses you have to repay it. And if you don't repay, then within 60 days of the expiry of 15 days, you will repay them with interest of 12% per annum. So there are really, these are, if you read it, these are more a protective clause from an investor perspective, right? Because private company, they may not know anyone and it's all privately done. So it's basically to protect the interest of a person who is trying to put in the money. So this is very, very important. Then the other one it says is, provided that money received on application under this section shall be kept in a separate bank account in a scheduled bank. So moment you get the money for the application, you will have to open a separate bank account and make sure the money lies there and it is not utilized for any other purpose till the pass 3 is there, right? We saw that earlier it was there, right? The company shall not utilize the money raised till the pass is filed. So till the time the pass is filed, the money has to lie idle, technically idle, right? In a scheduled bank account which is open for this purpose. And once that is done, you can obviously utilize for whatever purpose you have raised and whatever you want to do as per the issue documents.
Is there a restriction on a loan which can be taken against this balance in the account?
So generally, if you see the kind of accounts which you keep this money, right, it will be a current account because it's a private company. So normally based on current account balance, you won't get any kind of a loan, right? Because you can't pledge it or you
They
can't.
can always what they call place a lien on that balance.
No, you cannot do that. Lien is also not allowed to do. Because the moment you put a lien, you're sort of doing a utilization. Yes. And normally it is for a very short time, right? See, for
60
you,
days, 75 days is it?
yeah, that's all. 60 days maximum, but generally no bank will consider 60 days and give you a limit to do a borrowing. So normally what I have seen is bank will say you put a fixed deposit. Based on the fixed deposit, I will take a lien or guarantee and then give you.
point A, what are the adjustments it is talking about?
So primarily, if you are doing adjustment, you will have issue expenses, right? So some issue expenses, if you have, you can sort of adjust it against securities premium. It's a lot. I think this 7 point I mentioned where it said that you shall not release a public advertisement or use any media, etc. because this is more a private kind of replacement. So this is prohibited, and you will not even do marketing or anything through a public large. So primarily it is all prohibited. So when you are doing a private placement in a private company, you cannot release some kind of a marketing brochure, etc., right? Or you can't use any marketing channel agents to say, yes, I am doing this private placements, come you participate. No, it is all prohibited. Moment you start doing that, you won't fall under the rules of a public company, which then has a lot bigger compliance requirement, etc., right, to be followed, and regulations to be followed. So you have to be very careful. That's why I said generally, practically, it is a very private affair. You already identify few set of investors, you go meet them, get their interest, and then see how it happens, and once they are okay, you then release the private placement. Okay, so then going to the default, right? If you have if a company defaults in filing the return of allotment within that 15 days, then penalty would be like 1,000 rupees for each day continuous, but not exceeding 25 lakhs. So this is like a penal provision in case you do not file those returns within the prescribed timelines.
Each person or all together?
So I think it says company, promoter, directors. So couple of order which I have seen is they normally give it on each one of them separately. Yeah, so company will normally be a very sort of this working out, right? Whatever they are saying that for each day based on that working they do it, compounding. But directors, they normally, it's a discretion, so generally it tends to be little lesser, but still they also give something for directors. Yeah, so this is again a very important provision. In addition, see the earlier contravention was for not filing the return forms within timelines. Now, if any of the other provisions are not complied with, what happens? So the accepts money in contravention with this section. The company, its promoter, director shall be liable to a penalty which may extend to an amount raised to the offer, private placement. So let us say if I have raised 100 crore in a private placement, the penalty can go up to 100 crore, technically, right? That's
whichever is lower.
or 2 crores, whichever is
2 crores.
yeah. Maximum, so maximum is 2 crores, yeah. And one is a penalty, and then second, you will refund all the money with the 12% interest which we mentioned earlier. Within 30 days of imposing penalty, you will have to pay it, etc. all that. And of course, 11th subclause says that if you don't follow a private placement, then you will become a public offer and you have to follow all the SEBI guidelines, etc. All that securities contract regulation, everything you will have to follow if it is not a private placement. We'll go ahead. Okay, so that's all what was there in private placement. Now if you go to section, that was section 42. Now if you go to section 43, right? So section 43 sort of defines what are the kind of share capital a private company can issue. So if you see, I think we discussed earlier, it is equity or preference shares. Within equity shares, you would see an equity shares with voting right, and second equity shares with differential voting rights. Differential voting rights, there are rules which are available which says what are the conditions you need to meet to be issuing a differential voting right shares. Subsequently, I have a couple of slides on that. I will take you through. And then of course preference shares can always be either redeemed or converted to equity shares, whichever ways, right, it works, but that will also sort of help in getting the capital to a private company. Most of the if you look at the investment, right, which happens where a lot of funds invest or PE invest, they would prefer a preference route because they don't carry the liability, etc., which gets attached to a preference share, sorry, equity share. But at the same time, in case of repayment, etc., they get certain preferences which they would want, right, attached to that shares, which is easier to give in a preference shares. So like they say, I want these right attached. Maybe in equity shares, they may not be able to get all those rights, which generally comes in preference shares. And they will obviously have a clause which will say how they'll get an exit, either by conversion or through subsequent round of funding. So preference shares is very popular amongst the startups and on the funding community, right? Preference shares is very popular. And you have various series of preference shares which will come, which will give them different rights and whatever benefits they need.
So this tier 2 capital for banks and all, do they come under this differential right dividend or cash dividend, or are they bonds and something different from this?
They are more different from banks. Are normally public kind of a entity, right? So
for Companies Act applies to them because there are
correct. So that is not covered under this section. So there is a separate section under which they raise. For public companies, there is a separate way in which they can raise capital and funds. But yes, it is covered under the share capital section itself. But I have tried to cover only the private section, private company ones.
Sir, if holding companies are investing in this subsidiary, it will also be a part of this private placement.
Yeah, so you can use any one of them, rights issue or private placement or preferential allotment, whichever. So generally preferential allotment is made when everybody doesn't want to invest, right? Let us say you have two shareholders. One shareholder only want to invest, other shareholder says I don't want to invest. Now you have to raise the fund, right? So you will give a preferential allotment to him, say yes, one shareholder I will give an allotment. If both are ready to invest, you do a rights issue, right? Both will invest. So it is circumstantial how what it works.
Sir, let's say existing shareholders or directors have given certain loans to the private company. So now if I want to convert this debt into capital, what route should I use for doing that?
So again, that conversion will fall under one of these sections only.
Which
Any
one?
further issue of capital will be governed by this.
That seems.
But then, yeah, so
Which
there
one
is.
do I use?
It depends again on the circumstance, right? Who
No,
is
simple. There is a loan existing in my balance sheet, let's say of 2 CR. Okay. Now I want to capitalize it. That was given by, let's say,
it
director.
will be a preferential kind of, right? Because let us say there are 10 shareholders and 3 directors. Example. Only one director has given a loan, not all of them have given.
Yeah.
So you preferentially for one person you want to convert.
Okay.
Not all are participating.
Preferential.
Preferential is a more ideal option.
and this can get a premium.
Yes. Depends. See, all the share issue has to be backed up by a valuation report. I'll come to that later. Without valuation, you cannot do at all. There has to be an independent valuer who values the value and says this is the value and that is rate at which it can all be issued.
Even if I am doing it at face value, do we need a valuation?
So it depends, right? If you've just started the company and there is no operations, maybe you can justify that the face value is the fair value. But if you look at the valuation mechanisms which is specified, right? It says you don't go by book value. You have to look at discounted cash flow, future cash flows which will come, and considering all those valuation methodology, you will arrive at a value. While today it may look like today I have started, but that is not really a right mechanism to valuation.
I mean, considering it's a closed company, I mean.
That's fine. So it works in many cases, but generally you need to have a valuation. Because what happens, there are one, if you see preferential allotment, it says you need to, private placement, it says you have to have a valuation. Because in your explanation statements, you have to have. Even though you are 0, you cannot say because I am 0, I will not get valuation. So you don't comply with that. Second, main 2-3 other acts which requires you to have valuation is, see, Income Tax Act, there is a section called 56. So which says that you cannot issue shares at higher than face value to an Indian national, right? So you are sort of trying to disclose a lower income by getting a higher premium on it. So there is a prohibition. So moment you do that, the company is liable to deduct tax and pay tax. The liability comes in. Same way if you are issuing it to a foreign national, this is for the Indian national. Same way if you are issuing it to a foreign national, FEMA guidelines comes into picture. So FEMA guidelines clearly says how the valuation has to be done. And you cannot issue any shares at below fair value.
Even for preferential allotment,
Anything. So
valuation is compulsory.
Yeah.
So
that
you cannot
way-
issue a discount.
No, discount is prohibited. There is a separate section 53 which says that no shares can be issued at discount except for sweat equity. I will come to that later. Sweat equity is basically your ESOP, right? If you are giving to employee at an ESOP because you are getting an inherent benefit from it, that is the only mechanism you can. So it has to be at the face value. But valuation report is compulsory. Very, very important because you have to first comply with Companies Act requirement, second you have to comply with income tax requirement, third FEMA requirement depending on whom you are issuing. So one of these three laws you will get caught. You have to do a valuation. And also valuation, there is another catch, right? If you, let us say I valued it as 3-4 years back, I have a value. You will say my company operations are all same, nothing is changed. But still it won't hold good because the time is already lapsed, right? So I think recently income tax came with some guidelines which says 3 months. There is a valuation new rules which has come, which says maximum 3 months you can use. Earlier there was some guidelines which said 6 months. So you have to be very careful what value you are taking, what date that value is done, etc. Okay, so then here are some guidelines on issuing shares with differential rights. So we have rules under which they say how a differential right shares can be issued. So primarily, I think first condition is your article should sort of allow an issue of differential shares with the differential rights. And then any issue of this differential rights needs to be sort of approved by the shareholder in their general meeting. And the third criteria is the people who have this differential right cannot exceed 74% of your voting powers. It's not that more than 74% all have only differential rights voting. It can't. There is a capping on how much it can be there. So these are three primary conditions. We have some more. So for any company to issue a differential right shares, they have to sort of ensure they have complied with certain requirement, right? Like if the company has defaulted in filing their annual return in 3 financial years immediately preceding the year where they want to do, then I think you cannot issue a differential right shares. Same way, if the company has defaulted in payment of dividend or defaulted in payment of deposits or defaulted in redemption of its preference shares or defaulted in repayment of interest to its debentures, etc., right? Any kind of this default, then again you cannot go and say I will issue a differential right shares. Then of course you should have complied with the requirement of if you are falling under any of these laws, right, the state level financial institution or scheduled bank, interest rate payment thereon, and also transfer of money, crediting to the investor education and protection fund. So all these have to also be complied with. So any of these default if you have made, then again you cannot issue a differential.
So between F and G, F says no subsisting default.
Yeah,
G says no default.
yeah.
It means 3 years back also if it defaulted, they can't.
They can't do it. So that's why there is, if you see that provided, right, that provides, if you see, they have given a sort of a transition option where you say if 5 years have lapsed since you have done all this default, then you are sort of free to do it again.
Even if it is like continuing.
Yes, yes. No, it has to be remediated. Upon expiry of 5 years from when default is done. So if default is done in this current financial year and it is remediated, After that, you have to look for this credit.
After 28, if it is remediated now, after 5 years.
Yes.
28 they can do.
Yes. Correct. Again, if you have been penalized by any of the court in the last 3 years for any offence under RBI, SEBI, Securities Contract Act, FEMA, right, or any other special, then there is a problem, you cannot do it. So it's basically, if any kind of a default, right, if you have, it's very difficult to issue a differential shares with differential right. And
Does it happen? I mean,
Yeah.
private companies.
Very rarely, not very always, but it does happen because.
What would be the circumstances?
So what happens is there are situations where you are, let us say you are a promoter, right? I'll give you a typical example which you have. You are a promoter, but you want to run the daily operations, right? Because you raised further funds, your overall shareholding from let us say 75% has come to 15%. Now you don't have any say in what operations can happen. So what for you to be empowered to run the operations and do it properly the way it is required, then you say okay, you take a differential voting right shares so that your shareholding goes up to so much, right? You voting for goes to so much. So it does happen, not very frequent, but yes, there are various companies which will have differential. Because some class of shares you may not want to give the same rights which you have. So you may also want to restrict, right? Let us say you are a promoter, you have 100% shares. The converse of what I said. So you may want to get an investor, but you don't want investor to be sort of interfering in your operations, right? So you will say, I will give you shares, but you will not have any voting rights like how I have. Or I restrict the voting rights. While he has a share capital equivalent to mine or more, but his voting rights will be limited. We go through. I think that's what we had on the differential voting rights. Then we go to the sweat equity shares. So here again, this 53 says notwithstanding anything contained in 53, under 54 you can issue sweat equity provided 53 actually says that you can't issue it at discount. That's what 53 says. But in 54 it says notwithstanding that you can issue it provided it is authorized by a special resolution of the company and all these specific requirements are. I'll take you through those in the next slide. And I have a separate slide on ESOP, so I will take you through that. So the next section 55 talks of issue of preference shares. Here again similar to the equity shares, only difference is here you cannot issue irredeemable preference shares and the maximum period for redeeming any preference shares. So you can either convert a preference shares or you can redeem a preference shares. So the redemption maximum period is 20 years for normal companies, and I think for infrastructure companies it is 30 years. But if it is 30 years option, then I think there is a limit of saying some percentage of redemption has to happen each year. Some kind of a clause, 10% I think it says after some years you have to do. So that kind of a clause is there. So I think overall 20 or 30 years, it can't go beyond that. So this is a very popular mechanism of getting funds in various startups because preference shares give a lot of preferential rights to the investors. So they say I have these rights, so they carry those rights, and the next set of preference investors will have different set of rights, so which is a privilege they enjoy. And then in the end they may choose, right, at the point of exit when they are looking, they may choose to say I exit the way it is or I convert it and then exit. So whichever ways it happens.
From company point of view, which mode of issuing the shares is better from company perspective, not from investor? It is preference share or share capacity. Means I want to ask with the stock market perspective. Suppose a company, two companies are there. One is taking the path of issuing the rights to raise the fund, and the another company is issuing the preference share. So if I ask you which companies from
Which is
stock
better?
market angle, if the two company are listed, one is raising the funds for the right issue, another company is raising the fund for the preference issue. How would you see that which company is doing the better action in maximizing the shareholders' wealth, whether it is through preference share or through right issue? Which one is better for, means wealth perspective for the stock market?
So rights issue can also be for preferential share. So rights issue need not be only for equity share.
No, means, but
It
the
can-
right issue, generally you are having the voting rights. You are having the all rights same as equity holders. In the preference shares, you are having some preference kind of rights. You are not having the voting rights. You may have the preference of interest or whatever the preference share dividend or something like that. So from a controlling point of view of the company, if I look at the stock market, see which shares price will go up on the just if the decision by taken by the company, if it is right issue or the preference, which one is better?
So if you really ask me, both are same. Okay, I have full share capital here, right? Which will have equity and preference. So preference is like what I would call a quasi capital, right? So you always have the.
It is sort of debenture only. Now preference share is more like a debenture only.
No, not necessary. That's what I was trying to tell you. So you always have, because it is quasi, right? You can always have an option to say I will have to compulsorily convert it. So moment a preference share is like a compulsorily convertible kind of this one. It will assume almost the form of a equity share. When you only say it is going to be redeemed, then it will not be your equity, it will be a debt. So if you really see, even from an accounting perspective today, right? If you are following the Ind AS or any of the which one applies to the listed entity, you don't really see a preference share. The quasi line is no longer there. So you assess at the issuance, right? At the initiation of this preference share, you will conclude whether there is an equity element in it or whether there is a debt element. So the moment there is an equity element in it, you move it up in equity and show as preference equity. Whereas if you say it is a debt, then you do show it as your borrowings. So it again depends on the nature of elements which is inbuilt in it. Plus also I have seen a lot of preference share being issued where they have voting rights. They have preferential voting right, much better than an equity share. So that is why I said people prefer preferential.
Private company, not in listed.
No, not in listed. It is a private company only. They give it because that is why many investors prefer preferentials, because they can get lot of rights which generally an equity shareholder may not get.
Private fund trading.
Correct. So preferentials, they can say I need all these preferences. They say okay, all these can be given. You can give it.
Preference shares saying better voting rights than the equity shares.
You can always have, yeah. It is up to you, right? How you can always say one of my preference share will give it to voting rights.
But still I did not get my answer of question. Suppose there is from stock market for a listed company, if two companies are there. I am giving you the example, recent example of the OMC companies like IOCL, BPCL and the HPCLs. The government wanted to fund them 30,000 crore rupees.
Yeah.
IOCL, BPCL are raising through rights.
Yeah.
And HPCL is raising through preference share alone. So from market perspective, because definitely it's a listed company, so they won't have the voting rights. So which ones you should look at from the stock market point of view or from the wealth of shareholder wealth, which one will trigger more to the stock market? Preference or right?
No, so if you see, both are only a mechanism in which capital is raised. See,
But
once-
it's affecting the rights of the other existing shareholders.
Yeah, yes.
Because suppose if I am saying if the IOCL is making 10,000 crore of profit,
Yeah.
so and they are giving the rights,
Yeah.
so they are diluting the rights of the existing shareholders. So it will be same as par with that. But suppose if the 10,000 crore of rupees the HPCL is having the profit, and if they are issuing the preference share with the 9% of the
Yeah.
dividend,
Yeah.
so it is at par with the debt. So the residual value of the EPS, if you look at the
Yes.
EPC and that will be better for the existing
Right.
issuer.
So this basically, that's what, in a money market you will have to understand how a company will be able to raise the funds. Every time I say I want a rights issue, all of them may not be ready to invest in me. While I may want to do it, like what you said. So the company will evaluate, right? It will say, okay, now I will consider this option. How will this benefit me and my stakeholders? Same way, the other company will evaluate, and based on their objective, they will decide which has to be done. So I cannot really say this is the right in all the circumstances and this is the right in
Depends
all
on
the
the company to company.
Depends on the company and also the situation. Yes, what they are trying to do. See,
If
they
the company is making less profit, it will be reversed.
absolutely, yeah. Everybody will want to invest if it is good, right? And then the easily right issue will be successful. Whereas if it is not the case, then they will know it. So they don't want to go to a right issue and say it is a failure. So they will then go for a private placement, some partly right issue. So it's basically how they want to manage the
But
capital.
if the company is a profit making company and if it is a good performing company, always if the shareholders' rights are not diluted, that in future they give you the return. If you dilute the rights,
Yeah.
so if automatically the future benefits.
If the
are-
fundamentals of the company are good, I think there is no problem at all. But how stock market works, nobody can guess, right? See, today you have so many stocks trading at below their book value also, and so many stocks which are at negative PE also. So nobody can second guess and do all that.
See, the stock market always react very fast and in very authentic manner. Whether we may not guess the things, but they react very because
Yeah.
the information they have, the insider information also. Because each and every information which is impacting the things, in short run, in short period, definitely you may not be, you may not get the correct picture. 20, 30, 40% of the range may be there.
Yeah.
But in the long run, always the company fundamentals
Yeah.
only drive the market.
Yeah.
Because no operator can drive it for the 5 years.
Right.
If it is the large scale company. For a small company with 1,000 crore of capital, then it can be. But if it is a 25,000 crore, 1 lakh of crore, no operator can make a manipulation for more than 2-3 months.
Yeah, yeah. So short term will always be fluctuation, but if you stay long, it will always be good. Okay, so preference shares, I think I mentioned you can maximum issue it for 20 years, same irredeemable till 20 years, but it can't go beyond that. Yeah, now go to the other section, right, 62, where further issue of capital can be done. I will quickly run through quickly on this. Only the key points I will take. So in this case, in case of further issue of capital, the offer shall be made by notice specifying the number of shares offered. So if you are making a further issue, you are making an offer, you will say how many shares you are offering, and limiting a time limit of not less than 15 years. So and not exceeding 30 years. So 30 days. So here from 15 to 30 days, you will give them time to sort of respond once you have made a further offer to them. So they have around 15 to 30 days. Within that time, they will have to come back and say, yes, I have accepted this offer, or I have declined this offer for a further issue of the shares which you have made. Yeah, so unless the article otherwise provides, the offer shall deem to include the right exercisable by the person. So every person who is the existing shareholder by default has this right unless the article says he does not have a right by issuing some differential shares to him. And after the expiry of the specified time, that is your 15 days or 30 days, whatever timelines you have given for them to accept it, the notice of and the receipt of that intimation will be considered, and if he has declined, then the board can dispose it in such manner. They can offer it to somebody else to say, yes, look, we wanted to do so much, this is what it is. In fact, it can also be renounced, right? Some shareholder can say, I don't want to do it, I will give it to somebody else. They will do it and they will use it, right? But yes, of course, your percentage shareholding will change because of that, but company will have to raise the funds, so that is how it will go further. Yeah, so 62B is a section which deals with ESOP, where it says that under further issue of share capital, you can also issue employee stock option, subject to regulation and everything. There is a rules which is formed. I think I have here I am covering the ESOP.
So just a
Yeah.
second, just before we come to ESOP. So let's say I want some money as on 31st March, and one of the directors gives it to the company, let's say somewhere around 50-60 lakhs. Now subsequently, so it is decided to issue shares for the same amount. Now as on 31st March, can I actually show that as share application money pending allotment in my balance sheet?
Yeah, so for you to, he's already a shareholder?
He's a shareholder.
Existing shareholder,
He's a
yeah,
existing
because you can't get a money from non-shareholder.
Exactly.
Yeah. So now for you to call it share application money pending allotment, right? You should have somewhere had the call for allotment. Those process should have happened, right? Where you will say, yes, I want to issue further capital, and this is the means I will issue, and I will call for further money. So those process you will have to have, which will say that yes, the company wanted to issue the shares, and they passed these resolutions and they called for this money, and then they have got this money. That is one.
Just speaking practically, that's it.
No, that is very difficult. So you will have to subsequently say you got the money and that money was converted to equity, right?
So I mean, let's say there are a lot of companies who closely held companies, they just want money, they just pump in some money, they use it.
But then timeline also you have to see, right? You have to issue, once you get the money, you will have to issue it within specified timeline. You can't keep it for.
Understand? I mean, let's say I'm filing the pass, I do a preferential allotment. I'm filing my pass form with a late fee, somewhere in the month of, let's say, August or September.
Yeah.
So, would it still be fine?
Yeah, but allotment, there is a time limit for allotment also. Pass filing, yes. After allotment, there is a time. But money which you collect as share application money. So now let us say on 31st March you got the money.
Correct.
But next 6 months you did not issue it. And then you say I want to call it share capital. Then you will have a problem because it says within so much timeline you will have to allot the shares for getting.
Let's say I show that instead of share application money pending allotment, I show it as a loan from director.
Correct. So loan from director, then you will have to do a conversion of loan to so issue of shares for consideration other than cash. There is an option. You can use that option and do it.
Okay.
So normally that is the most compliant option where you will really show that year end he paid the money. Okay, so you treated it as a loan and given interest, etc. All that, did all the formalities, TDS, etc. Then subsequently, whenever you called for the share application money, then he said you convert my loan into capital, and you followed all those requirements of Companies Act and then converted.
So that particular transaction can it be called other than cash?
Yeah, it is other than cash because
the amount has been received in cash only.
yeah, but if you see the options which is available there, only if you get directly money when you are calling for allotment, it is called as issued on this one. So when you are converting, right? If you are here, if you are seeing the transaction, first transactions was my loan, second was conversion of that loan to cash. So that is where they say conversion other than.
So accounting will decide the timeline.
No.
When you are converting these things from this, you said like the
Correct.
So the way you show
60
You
days
can-
will be determined from the timeline when you are passing the accounting input.
And the board resolution. The board will allot it, right? So board will say I will do the I want to issue the shares. So moment you say you want to issue the shares, you get the money, then you will get.
60 days will be counted.
So let us go to the ESOP. Yeah, I think here applicability I want to sort of check. I think others we have discussed that it has to be approved by the shareholder, special resolution, etc. So if you see, it says it can be given to an employee. Now what is an employee is defined under this 62(1)(b). It says employee means permanent employee of the company who has been working in India or outside India. So it does not matter which location he is working, as long as there is an employer-employee relationship, you can give him an employee under this employee stock option plan, right? You can give it. And then, or a director of the company, whether a whole-time director, but excluding an independent director. So other than independent director, if he is a director, he will also sort of be eligible for this ESOPs, right? Of course there are restrictions, but he is eligible. Then C, an employee as defined in A and B above, that is the director and the employee of the company who is working in India or outside India, of a subsidiary. So if I am a holding company or I have a group of entities, so one entity can give for the employees of the subsidiaries as well, so or of the holding company. So within the group, one entity can choose to say I will give for all of them, even though he is not my employee, because he is my employee of my subsidiary company or my holding company, this will be given. But does not include, this is very important, an employee who is a promoter or person belonging to a promoter. So if you see, there is a prohibition on issue of ESOPs to a promoter group. So promoter group you cannot give it. Or a director who either himself or through his relative holds more than 10% shares. So if I am a director holding less than 10% shares, I fall under that employee definition. If I don't hold, if I hold equity shares more than 10% and I am a director, then I fall under this promoter category, or not really promoter category, under this exclusion clause. So I cannot be given an employee stock option. There is some exception to this promoter and this 10% rule. So in 2019, government came with a notification saying if you are a startup, just to encourage some startups to sort of enable even the top level management and promoters to get some ESOP benefit, because they also work, right? They also put in a lot of effort. They came with a notification which says that if you are a startup meeting those definitions, etc., there can be an exception up to 4 years or 10 years, depending on what it is, it can be given. But the general rule is promoters, director holding 10% cannot be given an ESOP. But if you are a startup meeting certain criteria, then you can be eligible.
So we have this concept of ESOP, right? Is that what the what
Yeah.
you mentioned?
Yeah.
Startup.
So ESOP, you see, they just call it ESOP, right? So ESOP can be for management. So maybe management do not meet the promoter and this director 10% criteria.
This director can be whole time or not? Previous slide. This one, a director of the company, whether a whole time director or not.
Yeah.
So means it
Any of them.
can be a non-executive director.
Yeah.
Not holding any shares,
Yeah.
not doing any work.
Yeah. No, but if he's an independent director, you can't.
No, but see, independent director is different. Suppose if there are two directors, one is the executive director, working director or whole-time director. Another is sleeping director. Sleeping doesn't mean that he is an independent. He may be some related
Right.
to some.
Fine.
So the sleeping director will have the right to get a ESOP.
He will be eligible to get. He will not get a right.
I mean, he is eligible.
Yeah, he is eligible. So now whether we need to give him or not, the company has to decide.
But the company is not barring the.
No, they are not. They
Only
can
independent director they are barring the.
independent directors, promoters, and 10% shareholder director. So they become eligible. Okay, so this is a basic criteria. So there is a full guidelines on how an ESOP has to be framed and done. I would not go through in detail. Very quickly, I will skim through those. So here, what it says is the company granting option of ESOP will have the freedom to determine the exercise price. So this is where I can say that my share is 10 rupees, but I'll give you free of cost, right? You don't even pay any bucks, which is more like a discount, but it is allowed under the Companies Act. 54 allows it. And then they need a separate approval for shareholder by way of a special resolution if they have to give it to employees of subsidiary holding company or any other identified for more than 1 year. That anyway is a standard clause you will always have to get. So generally a company frames a ESOP policy. They make a policy to say this is how ESOP will be granted, these are the people who will be eligible, which will be in line with this this Companies Act requirement, and then they will say this will be approved by the shareholder in the special resolution, and there they will say okay, these guys will be allotted, this is what will be done, right? They will form a committee which will allot it. So that is how it will work. Yeah, so here another key point in ESOP is you should say that if you look at the subsection 6A, right, it says there shall be a minimum period of 1 year between the grant of option and the vesting of the option. So this is a very important point. You cannot give any ESOP to any of the employees which will vest to them in less than 12 months. As per Companies Act, it is prohibited. So this is a very important clause under ESOP. While you may have an employee working for a very long time, whatever, right? Whatever criteria it meets, there has to be a minimum 12 months of vesting period. If that is not there, you are contravening with the provisions. Yeah.
What is the idea behind this provision?
Okay, I'll give you the philosophy, right? See, basically what happens? Why are you giving an ESOP to anyone?
Retain.
Basically, you are giving, no, retain is secondary, right? So, what is the benefit the company is getting? The benefit, because he is continuing in the organization, there will be some sort of whatever, right, contribution he will do, for which you are trying to attribute some value in the form of an ESOP, right? Compensating him through an ESOP. Now, if let us say, if it is below 12 months, it's very difficult for you to say you got the benefit, right, from that person, right, from that employee who was working, and still you gave him this compensation.
But it can also be so he worked for last 3-4 years and.
Correct. That's fine. That's all there. So if he worked for last 3-4 years, you always have the option to give him ESOP 3-4 years. Not really locking, minimum vesting period. You have to have 12 months vesting, otherwise that means you have to work for 12 months, right? Otherwise, see what will happen. There can also be situation where people can misuse, right? Somebody can come as an employee, just work 1 month, 2 months, takes huge shares and go off. I mean, it can be used in any manner. So they just want to sort of lock the period so that minimum there is so much. So that the company gets that benefits which is actually measurable in 12 months.
He must work for at least that period.
12 months, minimum 12 months should be there, then only you can rest. And also the philosophy of ESOP is to look for future value which he will bring on the table, right? For which you are compensating. So it is not a bonus that, okay, he performed well last year, so I'll pay him bonus. It is not. So there is a distinction, right? It is, you are trying to compensate him for something which he is going to contribute in the future. And that contribution period should be some minimum period, right? You can't say 1 month I'll give him so much.
So the ESOP can be with the, this 10% every year that can, like you can exploit 10%.
So it is called graded vesting. What you are telling. So normally they give for 4 years, they will give some percentage each year.
One clarification. So what happened in some of the startups that it has happened ki, like there were some bonus payment they had to do and they were not having money, so they have issued a ESOP with immediate vested ESOP, immediate effect. What is that?
So that is prohibited. It is not in compliance with Companies Act.
Not ESOP.
What is
Phantom stock option.
What stock option?
Phantom stock option.
So does it fall under the requirement of Companies Act?
No, it's basically not ESOP. It is
a
compensation linked with the
ESOP.
valuation
Yeah,
of the
so the
company.
way the phantom stocks work is, so if it is not falling under this company law requirement, right, the ESOP which is there, It is fine. So the way a phantom stock will work is, from what I understand, there will be a price pegged at which you are given option, right? So today, let us say 100 rupees is the price. You say I will give you 100 shares and 100 rupees. So that is a phantom stock. Phantom means you are not really given any stock. It's a sham, right? Phantom. That's why it's called phantom. So after 1 year, the stock value becomes 120. So this 20 rupees gain is given to you as a benefit, right, or a compensation, whatever. So since there is no shares issued or anything like that, I think it does not fall under this requirement. But again, you have to check, because anything you are trying to give under this scheme has to comply with Companies Act requirement. So if it is not under this framework, you can call it phantom, but it will really be a bonus, deferred bonus.
Can you issue a sweat equity immediately?
No, you can't vest immediately. Yes, that is the point. Minimum 12 months has to be there.
So, see, sweat equity is part of ESOPs.
Correct. So the only way you can issue is as per this guidelines only, and these are the people who are eligible. So it can't immediately vest. So there is a minimum 12 months. I think this is a very, very important condition brought under Companies Act 2013 when it came. Earlier it was allowed, but once this Companies Act came, I think it was very different, distinct, right? Everybody had to follow from whatever they were doing. Okay, so these are the key points in ESOP. Yeah, so here again the company will have the freedom to specify the lock-in period, etc. All that, I think it will be based on a policy. There is no restriction. The company will frame a policy. It will say this is a lock-in period. This is why it will rest. If you leave, what happens, right? If you continue and you don't want to do, what happens? So all those permutation combinations will all be available in the policy, which will be made and which will be approved. And as per that policy, they can follow whatever happens, right?
For ESOP only the board resolution is sufficient?
No, shareholder, the overall policy first what you frame has to be approved by a shareholder.
Overall policy.
Yeah.
But subsequently,
Which will give the limit, right? Because there is a limit overall saying so much are the shares which are allocated towards ESOP, and this is how the policy is and how it will be. That has to be approved by the shareholder. And then subsequent allotment to the employees can be done through a mechanism which they devise.
suppose in the general meetings you have decided some amount, is suppose 10 crore or 20 crore of worth of ESOP you want to issue.
Yeah.
And during the entire year, through one general meeting resolution, you can issue the ESOP to all the employees.
Yeah, so typically what happens is when they make a policy, the shareholder meeting, they will say that let us say I will give you some 5,000 issues, shares I allocated for giving it to eligible employees, the ESOP. And that policy will also say how will this get allocated, who will allocate it. So generally they will form a committee, let us say a nomination committee, a remuneration committee, or a performance management committee, right? That committee will review each performance because it is performance based. So they will review that performance and they will say for eligible employees, they will identify how much has to be given and they will issue it. So it will be administered by that committee. While an overall umbrella approval will be there, within that umbrella approval, these guys will allocate.
There will not be any such limit of the amount or certain.
It is. So overall, the amount of ESOP will be determined by the shareholder approval. So shareholder will say this is the maximum ESOP pool which can be given. Within that pool only you can do anything. If you want to alter that, again you have to go back to shareholder and say I want to increase this or
And that can go over the number of years.
Yes.
In one general meeting resolutions,
Yeah.
it can go over 2, 3, 4 years.
Yes. It is up to you how long you want to issue it. Depends on how many eligible employees are there.
So during allotment only the board resolution is required.
Initial first approval of the scheme, that time shareholder approval is required. Subsequently, when they are allotting, if they say the committee will approve, committee can approve. Board also is not required. But when the shares get allotted, that time you have to follow those procedures, right? You have preferential allotment, whatever, that you have to do. You will have a board resolution saying I am allotting in specific shares, all that.
For issuing this, and I saw only the committee and this selection.
Yeah.
And at the time of conversion or exercising these rights, you are saying the board resolution.
Correct. Because when they convert it is when it becomes so. What we are giving to employees now is only an option. It is not a share. So that option will be lying. Only when they exercise the right to convert that option to equity share, the company will be obliged to allocate shares to them. So when they are allocating, they will have to follow the board procedure. Okay, so the option granted to an employee will not be transferable, right? I cannot say, okay, I am an employee, I am leaving, I want to transfer it to one more employee, my friend, and then go. That is not allowed, that is prohibited. Generally, that is not okay. And you cannot pledge these hypothecate or whatever, right? Or whatever options you have, it has to be free of encumbrance. Yeah, in the event of death of an employee or something, then it will rest to the legal hire. It is not that it will just go off. The company allows that the legal hire will be able to, let us say so many shares are vested but he is not exercised. So all those can go to the legal hire and the company can transfer, or will have to make sure that their legal heirs are getting those options. Yeah, so in the event of a resignation of a termination of an employee, whatever is not vested, right? Whatever is vested is already vested. He can exercise. Whatever is not vested will expire. And normally the scheme will specify up to which period the unvested shares or the vested shares, right, which is not exercised, can be exercised by the overall policy which is approved by the general meeting. It will say what period up to which, like generally they say within so many years you can come back and then ask for the, because the moment you want to convert to equity share, it is a cash outflow for an employee, right? Because whatever is the price he will have to pay and then say I am getting these shares. So it's a very sort of a dilemma situation. If he is not getting exit, he will just have shares of a private company for which he would have paid the money and he will not know when he will exit. So it's a little tricky situation. So everybody may want to time when they are probably looking at some sort of an exit. So they will generally, company will give them a lot of time to sort of decide when they want to exercise it. Okay, the next one is on the bonus issue. So bonus issue, I would not go much into it, but I think normally bonus issue you can capitalize by using your free reserves, your capital redemption reserve account, or your securities premium account. You can use any of these and sort of capitalize, you to increase your number of shares. And section 63 deals with the issue of bonus shares. It's very unpopular now in private companies. Earlier it was popular because this was a routing mechanism through which you could repatriate the money back. But now because of the tax laws, it is not done, nobody does it. Or very rarely it is done.
Can just elaborate on the tax part of it?
So earlier what used to happen, see, there are 2-3 ways in which you can repatriate the money, right? Either through dividend, where you will have to pay dividend distribution. So earlier bonus, there was a flaw which did not tax them. So tax free it was going. And then some period they bought a very minimal tax. The effective tax was 10-12%, whereas your 8 year for any person was 20-30%. So there was a gap. Now they have made all in line, right? Your effective tax rate is what applies to everywhere. Dividend, bonus, whatever you do. So that way it doesn't matter at all.
So who will pay? The company has to pay the tax on issuing the bonus.
TDS, yeah, there will be a TDS which will happen. Yeah. Like dividend.
It will depend on the valuation of the shares.
Yeah, obviously, yes.
According to valuation, they have to pay.
The amount which you capitalize from your reserves will be based on a fair valuation which will be done.
But you said the TDS has to be deducted.
Yes.
So, but while you are issuing the bonus share to the NRIs or the foreign investors, there are no outflow of the case. So how the company will pay the TDS from their own pocket?
So
or
they
will
correct. They will have to bear the cost. That's why they don't do it. So it's an
So they will
incremental
gross up
cost
the-
to do the TDS and pay.
They have to gross up like,
Yeah. So they will have to gross up, right?
suppose 100 valuation of the premises. So
Tax you will add.
then
Cross
you
it.
have to deduct the effective rate.
Yes.
And then finally the 100 will be.
So that's why it is now a very inefficient mechanism to do anything. So nobody is, at least in the private companies, they don't do, because it's anyway not liquid, right? After doing all that, you still having a private share. Okay, so the next section is on debentures. I think debenture is more similar to preference shares. It's just that preference shares are shares. Debentures, only if debentures you will convert it into equity shares, it takes the form of an equity. Otherwise, it is mostly a debt. So there are again rules on how you can issue and all that. I will not get into that detail. But debenture also is a mechanism to raise your capital for private companies. So company can choose to say, I will issue a debenture and convert it into equity share capital, and the conversion terms can determine how you want to convert, when you want to convert, etc., all that. But till the time it is converted, it will remain as your debt. But then once it is converted, it goes and sits as your equity capital. So basically a debt which gets moved to your equity. Okay, that's all from this one. I had some case studies. We'll quickly go through it. I think we have some 15 minutes. I have some 10 case studies. Quickly we'll see. Okay, so this is the first case. This is basically based on whatever so far we have been discussing, right? And I'll leave some time for you guys to read it.
See.
What is the option?
See.
C, they have to keep in a separate bank account.
Schedule.
Yes.
Any different views? No, it's right. You have to keep in a separate bank account because 42(6) says application money has to be kept in a separate bank account in a scheduled bank. Okay, even non-scheduled is a problem, and it cannot be used for any other purpose till you've done allotment and pass and all that. That's very good. So the next case we have. Yeah. So here the company has approved issue of shares on 22nd July and the company received the application money on 28th. The shares were issued on 30th July. So 28th money came, within 2 days they issued, and PAS 3 they filed on 2nd August, right? All within timelines.
D.
What can company do with these funds on 28th July?
A,
D.
On 28th, what they can do?
D.
A is it?
D.
B. B?
no, it will be A.
So here if you see the shares were, money came on 28th and the shares were issued on 30th and the PAS 3 was filed on 2nd
So
August.
you are saying you cannot do the fixed deposit.
Yes.
So on that basis you will not.
No, because even deposit will be a utilization of the fund. So here we cannot utilize, we can't put it in a FD or we can't use it for our purpose, right? Whatever, until unless the PAS is filed. So we can't utilize it. Very, very important. Okay, the next case study. I think we discussed this. So here the company issued some ESOP to eligible employees, and as per the scheme, the shares vested to employees every quarter. So is it in line with Companies Act?
If it was
No.
issued the corresponding previous quarters, yes.
Absolutely, that's why I have that maybe for you. Okay, so here it's slightly tricky, right? The first few quarters it does not meet the requirement, right? But the next year, which is after the 12 months, right? After the first 4 quarters, then yes, it meets the requirement. So you have to be very careful. It is yes and maybe. Okay, the next one is okay, so there was an approval on 8th May and the application money was received in existing bank account on 12th May because company did not have a separate bank account. So they opened a new bank account and on 13th they transferred the application money to a new scheduled bank account. So what happens?
So they cannot take money in an existing account.
Absolutely. So we cannot receive the money in the existing bank account, whatever may be the situation, because the rules and the section is very clear, right? It says money has to be received in a separate scheduled bank account, right? Bank with a scheduled bank.
Does this apply for preferential allotment as well?
Everything, for everything, any allotment it is like that. You have to keep in a separate bank account.
But means this provision has come into force since when? Because earlier all the private companies were taking the amounts in the current account only, which were the
This provision is there from the beginning.
But still the companies, private companies are accepting the funds and this taking credit to the current account.
Absolutely.
And there is no means you can say no action from the ROC or something like that. They have never inquired for this.
No, so whatever they are doing is not in line with the requirement of the Companies Act. So recently I have when Pramod was there, I was talking, I have seen a couple of orders which have come where they have sort of treated this very critically, ROCs in the order. So technically if you don't do this, you will have
to the time of initial subscription of the company.
Initial subscription, I think this does not come. None of these sections come under the initial incorporation, right? Your initial money which comes.
You were saying in a first subscription, this is not part of
it. It does not apply. These are all further issue of capital. Initially, I think it is okay. The further ones where you are doing subsequent capital raise, it has to be included.
If the company is regularly raising capital, it can have a permanent bank account for getting this.
Absolutely, you are right. So, a couple of my clients, what they do when they have multiple round of funding, they create one account which says capital, whatever, right? Share capital account. So, the moment allotment is there, money comes there, allotment is there, that is transferred and that becomes still a nil account. Next what happens? They use the same account. That is fine. That is still in compliance.
But before allotting the first one, second one starts means first one should be
separate account. You should have then in a separate account.
two separate.
But generally you can't run two allotment at the same time.
First you should finish first allotment.
Yeah, that's what the section says. You have to first finish your first allotment, then you do a new allotment. You can't run three allotments at the same time.
But
It should be a saving account or current account?
capital.
No, current account only. Companies have current accounts, right?
But only one current account in one bank is allowed.
But you can have multiple accounts, right? I think
Same
banks.
bank.
I think they open it. They know that this is for share account.
Specifically, they call it as capital account.
Capital account
This can
separately.
be used for any subsequent allotments
Yes.
also.
But in one allotment, if we are taking from multiple shareholders, it can
That is
come
fine.
at a time.
That is fine,
At a
yes.
time also.
You can have one account where you will get all investors putting in the money. That is fine. And you don't utilize it till the allotment happens.
It's parking.
Absolutely. That's what that's what I said, right? Sometimes it's too tempting, right? You have 100 crores sitting there and 10 days you didn't do anything. Simple FT would have probably given him huge money.
Have you seen any case where ROC has done something practically? Who has not parked the fund in a separate?
I have seen some orders recently only. I saw some orders where they see what happens typically when you don't comply with this. You have to go and file for compounding. So when you file for compounding, because it says 2 crores, right?
Correct.
And all that. So you file for compounding. Generally, earlier they would take it very leniently, right, and not do anything. But recently, in past 1 year or so, or more than that, I have seen a lot of orders where they have been very, very, very punitive. Some things which looks like a small compliance or administrative matter also, they have been reprimanded very badly. So recently ROC has been passing very such orders. Okay, the next one. Here the shares, they decided they will issue a discount. Can it be done? No, until unless it is ESOP, which is not the case, they cannot issue shares at discount. I think we discussed this. Here this is on the valuation. So 22nd July they approved issue of shares, and the shares were issued on 30th July. The shares were issued at a price higher than the fair market price. So what will be the impact? I think I touched upon when we were discussing. It's a slightly tricky question.
It would be non-compliance with the company.
Yeah, so primarily here what happens is if it is a Indian shareholder, right, then if you have issued it at higher than the fair market price, then you have a problem in the income tax act, right? It will be deemed income and you will have to pay a tax on it. But if it is, let us say, there are some exceptions to that rule also. It says if you have some approved investor and if it is a startup, etc., there are some exceptions which comes. Qualified institutional investor, then they are okay, it is not a problem. But if it is to a foreign investor, the FEMA valuation rule says that minimum you have to give it at the fair value. So it does not say you should not give it at higher than fair value. So you can always issue at anything higher than fair value. So if it is a foreign investor under FEMA, if they are given at higher than fair value, this is still fine. So it depends on the situation.
So for domestic, you cannot issue. In case of domestic investors,
If they are not meeting that exception criteria, then it is prohibited under Income Tax Act. So whatever is the excess will be treated as your income and you will have to pay tax on it.
as per so far as the Companies Act concerned, it is not obstructed.
So Companies Act says it has to be at fair value. Right? Now here you are issuing at higher than fair value. So you are sort of complying with the Companies Act.
You are saying from the Companies Act you can issue at higher value. Only from income tax point of view you have to pay.
So Companies Act does not say higher or lower. It says you have to do a value and at that value you have to issue. So you can somewhere sort of justify, right? My value was so much, value was so much, I issued it a little higher than fair value, which is fine, which could be fine. But even in spite of that, you have other sections, other acts also which you need to look at and not just look at Companies Act.
So if the fair market value is lower than the par, share purchase value, what happens?
So
90 is valued at 8 rupees, but the face value of the share is 10 rupees.
that you can't do it. So if the discount, you cannot issue a discount. So it will be minimum 10. You will have to issue it at minimum 10. But if you issue it at below fair value, Indian shareholders, it's okay to some extent. Well, it's not fine, it is somewhat manageable, but FEMA is a problem. If it is to foreign shareholders, FEMA rules clearly says you cannot issue it at below the fair value, which is determined by an independent fair value. So if he says 100 rupees is a fair value, you cannot issue it at 90.
No, here this case of what I'm talking is fair value is lower than the face value.
No, fair value, 53 prohibits issue of shares at below par.
But the fair value you are doing it.
So what will happen is the company will say that because I have whatever situation, my fair value is lower, but since it is prohibited, I will have to issue it at par value under this 54 and they will issue it at par. Only ESOP is what is allowed to be issued at below par.
Sir, one doubt. Let's say if the fair market value is changing after, let's say, 6 months in the second round of raising, will it impact anywhere my first fundraise? Let's say first fundraise I did in 300 million valuations. Okay.
Yeah. So what happens is each of your issue, right? Normally there is a time limit under which you consider each of the valuations. Each valuation will be valid for some 3 months, right? Like 3 or 6 months I discussed that. So within that period, you can consider that value and take that as a fair value for that issue. Subsequently, let us say if that period is crossed and you are doing a fresh issue, you will have to do a fresh valuation and issue at the fresh price. So it's not that I have one price and it will keep going on. It has a time limit under which it.
If once the FRP is determined, how many days we can use that?
Normally 3 months is an acceptable timeline. Until unless you have like some startups grow much rapid faster, right? So within 2 months they will be there here somewhere. So you have to also analyze. Well, that is an indicator somewhere in some of the law it says, but you have to also look at in each situation basis whether it is still valid or not valid. Okay, so the next one. Here the company had approved the issue on 22nd July and the shares were issued on 30th July. Application money came on 28th July. So the shares were not allotted because of some issue, right? And they had to refund. So within how many days they have to refund? 15 days, yeah. 60 days is for the interest. Within 15 days, you will have to refund back the money. In case you don't do it within 15 days, you will have to pay interest.
Sir, it's like 15 days from the expiry of the 60 days.
Interest is for like that. You see, the law says you have to repay the money within 15 days. If you don't repay, then it says you take 60 days and after 60 days you give interest. So the
That
repayment
means up to 60 days no interest.
up to 60 days without interest you can.
So that options given were not.
No, but the section says 15 days you have to repay.
No, sir, if you see that expiry.
If you see here, it shall repay the application money to the subscriber within 15 days from the expiry of the 60 days if the company fails to repay. So you have 60 days to allot the shares.
So altogether it is
It is repay
75
also.
days.
More than that actually, see your interest also will start after that, not immediately after 50 days.
So supposing it repays after 50 days,
Ah.
what happens?
So you got the money on next day, after 50 days you repay, that is absolutely fine.
So that means that options were not.
No, this is what we are saying here is
Even if it allots for after returns it after 50 days also, there is no, it's in compliance only.
correct.
So these options, one more option as 60 should have been included.
No, see 60 days is for you to allot. So what happens is you have 60 days to allot. After 30 days you decide I will not allot. Then what you should do? From that day 15 days you have to repay.
Here the how the word is the expiry of the allotment date, that should not come. That is when the allotment is not done, so where is the allotment date?
Yeah, here we are only trying to say by when you will have to give back days. So we have 30 days for 60 days for allotment. If you decide you will not allot, then within 15 days you will have to give it from the day it was decided. So here 22nd they approved the issue of shares and it was kept in a separate bank account on 28th July. The shares were issued on 30th. Okay, so by what date pass has to be filed within the timelines, right? Without exceeding the timelines. Okay, we have 15 days, right, for filing the pass. So I think very simple. So 13th August, which is the dates if you see here. You have more time. 14th I think it comes. But as per these dates, 13th is what works out. So within 15 days, pass has to be filed from the day of allotment. Yeah, here again on the valuation, the company received application money, but they have not done valuation of the shares. Are they in compliance with Companies Act for private placement? No, they have to do it because private placement requires you to give an explanatory statement which will have even the basis of valuation and the valuation reports. So this is more on bonus shares issue. What reserve company can utilize when they issue bonus shares? Sure. General reserve, right? Yes. So you can use general reserve because 63(1) says you can use free reserves. Capital reserve. I think the last one, I guess. Yeah. So at what price they can issue? So here the key point here is the company which I want to issue shares is a foreign company, right? ABC Inc. So it's in US. So FEMA guidelines sort of also kicks in. So we can't issue it at below fair value. So the minimum option which we have is 120 rupees, which is at the fair value. So we issue at fair value, which is in compliance with the FEMA.
But you can issue it at 150 also.
Yeah, minimum is.
If it's an Indian company, I can issue at 10 also.
Yeah, if it's an Indian company, you can issue at 10 also. Yeah, there is no problem. But you have to look at the Companies Act requirement also. If it is a private placement, that valuation, if he's saying 100 and you are issuing at 10, there is a huge gap. So that's why I am saying valuation is a very tricky game here. You just don't look at Companies Act or Income Tax Act or all the three you have to look together and then arrive at some sort of a situational, professionally you have to justify what it is. Okay, that's all I had. Any questions? Yeah.
So, with regard to ESOP, what are the exit options for the employees? Like, when will they really be able to get the benefit, cash benefit out of that? Is it only when the company goes for IPO? Practically, what is that?
No, it is not. I think there was some public news recently, right? One startup which went for new funding, they made sure some of the ESOP holders also get some exit. So what really happens, I have raised some funds, right? And subsequently I am also raising some funds. So that subsequent raise can be either primary or secondary. So some money will come to company and some they will decide, right? Some of the eligible employees, whoever. But it is again, so the liquidity is not 100%, if you ask me. The company will determine.
There is no law around it.
No law. Okay then, thanks a lot. Thank you for your patience here.
Yeah, on behalf of the branch here of Bangalore branch, we thank Mr. Sharath for giving a very nice, very clear analysis of what is the compliance requirements. It is very clearly explained. He has taken a lot of time to, I think, to make the slide itself, it has taken a lot of time. And he has been very lucid about the way he has explained. So I thank him on behalf of the branch and there is so many questions. That's also was very important.
Yeah, it was very
for us to
interactive.
clearly understand the intricacies.
It was interactive. I think all of you had a lot of questions and it was very nice. I also enjoyed. Thanks a lot.